Okay, let's dive right into this explainer. Welcome, everyone. Today, we're tackling something that is way more than just crunching numbers or debiting and crediting on a spreadsheet. We're getting into ASC 606, which is the US GAAP Revenue Recognition Framework. You probably know it as RevRec in the industry. But honestly, this isn't just a dry accounting overview. This is really about understanding the literal art of structuring a business deal in the modern corporate world. So let me hit you with a question right off the bat. When should a business actually record its revenue, right? For the longest time, people just naturally assumed, hey, the cash at my bank account, I've got revenue. Or maybe you think it counts the second the ink dries on a contract. But as we're going to see, cash absolutely does not equal revenue under strict US GAAP rules. It's wild, right? And to understand exactly why these rules are so intensely strict today, we really have to look back at how things used to be. Think about the stark contrast between the past and the present. Before 2015, the worldwide standard, and the US GAAP standard for that matter, was simply that revenue had to be recognized when it was earned and realizable. Which sounds perfectly fine, doesn't it? But here's the catch. The huge problem with earned plus realizable is that it left way too much open to human interpretation. Like, what exactly is considered earned? What makes something truly realizable? When you leave things open to interpretation in the corporate world, well, people get creative. And in accounting, creativity almost always leads to disaster. So that subjective mindset has now been entirely scrapped, replaced by a rigid, modern, 5-step rule-based framework. So here is our roadmap for the explainer. First, the Enron problem. Second, the 5-step framework itself. Then we'll break down Step 1, validating contracts. Step 2, performance obligations. Step 3, transaction pricing. And finally, Steps 4 and 5, recognition. Section 1, the Enron problem. Let's look at the historical failures that literally forced this massive shift from subjective to objective accounting. We absolutely have to talk about Enron. Enron was a massive energy company, and they notoriously exploited that old earned plus realizable rule we just talked about. Their argument was basically, hey, we produce electricity. The whole world needs electricity, right? The government's always going to buy it, so it's guaranteed to sell. Because they deemed their future sales realizable, they used mark-to-market accounting to recognize revenue for future, unrealized energy grids today, just thin air. It was a massive scam built entirely on the flexibility of revenue recognition. This total catastrophe in the year 2000 led straight to the passing of the strict Sarbanes-Oxley Act in 2002. And then fast forward just a bit to 2008, the entire housing market collapsed due to collateralized obligations. The historical lesson here, it's pretty clear. Corporations just cannot be trusted with interpretive accounting. Section 2, the 5-step framework. To stop corporate fraud in its tracks, US GAAP realized they had to completely remove all scope for interpretation and introduce a definitive, rigid system. It's a system based purely on rules. If the rule applies to you, you use it. If not, you wait. Here is the rigid framework we use today. A great way to remember this is using the mnemonic CPT Allocate Rev. Number 1, contract with the customer. Number 2, performance obligation. Number 3, transaction price. Number 4, allocate that transaction price. And number 5, recognize revenue as you satisfy those obligations. So let's jump right into the first step and see how this builds our foundation. Section 3, Step 1, validating contracts. The absolutely crucial point here is making sure we actually have a valid commercial agreement before we even start thinking about the money. You see, just because two people sign a piece of paper definitely does not mean US GAAP considers it a valid contract for recognizing revenue. To validate a contract, we use the ARPC checklist. A stands for approval and commitment from both parties. R is for clearly identified rights of the parties. C is for commercial substance. P is for clearly laid out payment terms. And finally, C is for collection being probable, which basically means you actually expect to get paid. Now, here is the absolute golden rule. If even one of these 5 criteria fails or is broken, the contract is completely invalid for revenue recognition. No exceptions. Let's actually zero in on that middle one for a second. Commercial substance. What does that actually mean in plain English? It means the transaction must fundamentally change the nature, timing, amount, or risk of your business's future cash flows. Here's an example. If you have a red sedan and I have an identical blue sedan, and we swap them just because you like red and I like blue, well, there is zero commercial substance there. Our cash flows haven't changed at all, it's just a barter. But
If I trade you my luxury VIP sedan in exchange for your delivery van, that has commercial substance. Why? Because I'm going to use that van to make deliveries, which lowers my expenses and directly changes my future positive cash flows. It fundamentally alters the financial reality of the business. Make sense? Now, what happens if your contract actually fails that ARCPC checklist? Say collection isn't probable, but the client still goes ahead and hands you a $75,000 non-refundable cash deposit. Do you record that as revenue? No way. Under US GAAP, that cash goes straight into a liability account called deferred revenue, or a refundable advance. Because you haven't met the criteria or fulfilled your obligations, that money literally isn't yours to claim on the income statement yet, even if it's strictly non-refundable. It just sits there as a liability until the contract is either officially terminated or the obligations are fully met. Section 4, Step 2, Performance Obligations. Assuming we actually have a valid contract now, let's move on to identifying what you actually owe the customer.
It's fascinating how the exact same work can be accounted for entirely differently based solely on your contract language. A performance obligation is simply what you must do to earn your right to payment. But how many obligations are in a contract? Well, a service must be both capable of being distinct and distinctly mentioned in the contract. Take building a shopping mall. Painting, plumbing, cementing, they all have independent utility, right? You could hire totally different people to do them. They are capable of being distinct. However, if your contract simply says, I will build you a shopping mall, that is treated as one massive, single performance obligation. You can't record a slice of revenue just because you finished the plumbing. But if you itemize those services explicitly in the contract, then you have multiple obligations. This allows you to recognize revenue step by step as each itemized phase is completed. The art of the deal is absolutely entirely in the drafting.
Section 5, Step 3, Transaction Pricing. Determining the price isn't always as simple as just looking at the final number written at the bottom of the contract. The stated contract value actually must often be adjusted for 4 distinct realities. First up, variable consideration. Let's say you get a $500,000 bonus if you finish building that mall in 12 months instead of 18. If you know for a fact you can hit that target, you must add that variable bonus into your transaction price today. Second, financing components. If a client is paying you $1 million over 3 years, the time value of money dictates that a chunk of that is actually interest income, not sales revenue. Your sales revenue is only the present value of that money today. Third is non-cash consideration, which we'll look at in a second. And fourth is reverse consideration, which basically means if you issue a special discount voucher to a specific client to use on their next purchase, that future discount has to be deducted from your transaction price right now. But let's look closer at that third point, non-cash consideration. Imagine a client hires you to build an office and says, hey, I'll pay you $1 million in cash, and I'll even throw in a slightly used Rolls-Royce. US GAAP requires you to determine the fair value of that non-cash consideration. If that car is worth $200,000 on the open market, your transaction price is definitely not $1 million. It is explicitly $1.2 million. You absolutely must account for the value of the goods or services traded in kind. Section 6, Steps 4 and 5, Recognition. Let's move to the final piece of the puzzle here. Now, we combine our adjusted transaction price with our itemized performance obligations to finally record the revenue. Imagine a company called EasySoft. They sell a software package with 4 distinct obligations: the software license itself, the installation, software updates, and technical support. If a client bought these totally separately on the open market, their standalone prices, they would total $1.25 million. But, in the real world, customers buy bundles. So let's say the customer negotiated a combo discount and bought the whole package for an even $1 million. Step 4 tells us we must allocate that $1 million transaction price across the 4 obligations using a pro rata pivot based on their standalone values. You basically figure out the percentage each item contributes to the $1.25 million standalone total, and then you apply those exact percentages to the $1 million actually paid. And this brings us right to Step 5 and the absolute core philosophy of US GAAP. You do not recognize revenue when you get the cash. You recognize it only as you satisfy the obligation. So, if you deliver the software license and install it on day 1, you recognize the pro rata revenue for those 2 pieces immediately. But the updates and the technical support? You haven't done that work yet. That portion of the cash stays as deferred revenue and is recognized smoothly over the duration of the 5-year contract, as the support is actually provided. It's like a giant puzzle coming together. So I want to leave you with a final thought to really reflect on.
If your business received a massive, non-refundable cash deposit today, would you survive a strict US GAAP revenue audit tomorrow? Remember, just because cash is sitting in your bank account doesn't mean it belongs on your income statement. Applying this rigorous 5-step framework is literally the only way to ensure your deals reflect absolute, undeniable financial reality. Think about your own contracts, evaluate your performance obligations, and ensure you're allocating value correctly. Thank you so much for joining me on this explainer. Until next time, stay curious and keep learning.